So how do you actually differentiate between companies? Like what makes a company a high quality company? Well, it's what we call a differentiator. And a differentiator is something that makes a company unique or gives it a competitive edge compared to its competition that is very difficult to overcome. Okay. When you think about large companies like Amazon, their infrastructure and their distribution network is already so large and so much, it's so insanely big that to mimic their distribution network would take insane amounts of resource and capital, and it's literally just almost it's implausible, if not impossible, to beat them at their own game, right? So that's something that differentiates Amazon from other companies.
Welcome to the Adapt or Die podcast. This podcast explores ideas related to self-growth, finding meaning, and living a more fulfilled lifestyle. It's your host, with the most, Armel Tala.
And it's your host, on the low, Ben Smith. We're two college students on our own path of lifelong learning with the hope that you will join us in our journey. And now, it's time for the next episode of
The Adapt or Die podcast. Welcome back to the second part of Laws of Wealth by Daniel Crosby. Did I say that right?
That was right, yeah.
I mess up with these authors' names. Please forgive me. But so, what are the main ideas for this episode?
Guys, today we're just going to be going over what he calls the state of money management, 4 C's of investing, or investing principles, I guess, and then the 5 P's of investing, which are his ideas on how to create a systematic approach to investing.
So, really honing it down to principles of investing and frameworks for investing. And this episode is very helpful. There's going to be a lot of information.
Yeah, very packed content today.
We're going to go through this with as little as possible of our opinion because we are not investing experts. So we're going to give you guys just straight the facts and how, with as little interpretation of our own, but just using examples to clarify anything that we may think can be confusing. With all that being said, though, definitely good read. It's one of those reads where I think that you should take your time to fully understand. Like the first half, I think part 1 was very straightforward. It's like, these are different laws.
Yeah.
These are examples. Like, it was really nice. You're like, okay, I won't do this. Now this second part is like, oh wow, like he's telling you, he's really giving you a guide to how to invest and I guess grow your wealth. So I highly recommend this book. With that being said, make sure you guys like, share, comment, please. I'm remembering to do this at the beginning. It means a lot. It's really helpful for the algorithm. So even if you don't like it,
You're such a CS major.
Just like
it's very helpful for the algorithm, guys. So please help us improve the algorithm.
I mean, the most important thing for the algorithm is the watch time. So you guys should actually fully watch this. Even play it in the background. Like just play it in the background. It doesn't have to, you don't have to listen. Just play it in the background. But please listen. There's a lot of value in this. But with all that being said, the state of money management when it comes to, I guess, investing. So there's 2 school of thoughts that is in the world of investing is passive and active investing, right? And so passive simply just means like you invest in something like the S&P 500 or some index fund, and in those type of stocks or those type of funds, they're not managed heavily, right? So maybe the people that run the fund like come together once a quarter or something and decide to adjust the portfolio of stocks they have, right? And then another thing is their low fees, since they don't do a lot of managing, very low fees. Now the difference with active, as the name implies, is the people that are running these funds. I think these are like different ETFs. If you're a billionaire, maybe you invest in hedge funds. I hope all of you guys can become as rich as you want. But so this just simply means that greater fees, because the people now they're constantly trying to, I guess, beat the market or beat this benchmark, the S&P 500, right? So really, it's like a war against the S&P and a bunch of hedge fund managers that want to be better than the S&P. But another good thing about active funds is that they try to mitigate risk, while the passive funds are just following the whole market. So if it goes down, it goes down, but you kind of get mitigated risk through diversification. We'll dive more into that. But some key ideas from what he talks about on the state of money management, besides the passive and active argument, is that because someone, like, if you go on the internet and someone tells you like, I pick these stocks and I pick these specific things, or even experts like active hedge fund managers, just because they did something and it worked, right? Like Michael Burry, he shorted the 2008 financial crisis. That doesn't mean that everything that they do afterwards is a good decision. And sometimes when someone picks a stock, that doesn't mean it was a good decision. If someone had bought Tesla like way back in the day, like now it seems like a great decision, but in that time, in that moment, it wasn't, and they didn't do it with a system. So what he's trying to point out here is that yes, someone might have picked a stock or something and it went really well, but if they did not have a system, you cannot replicate that. They just guessed and were lucky. And then the second thing is that when it comes to investing, what you're trying to do is not beat a specific index or market, but you're trying to take advantage of little things, right? And these little advantages compound on each other. So if you can find an edge of about like 1% or 2% compared to other investors, that like maybe people are overlooking this certain stock because it's boring, or people are, all selling because they hear this news, but done more research, whatever. You can find those little edges, exploit that. The compounding of 1 to 2% over time is a ridiculous amount. And last but not least, when you talk about passive investing is kind of built on the idea of efficient market hypothesis. So this simply means that the market is quick and efficient at incorporating all the relevant information into price, and that means picking stocks is really just futile. It's like, why would you even pick stocks? And this idea of efficient market hypothesis, which I'm going to go a little side tangent, it's the fact that we say that the market kind of prices, I guess to repeat myself, the market prices things correctly. It's like a reflection of what the actual true value is. And the way that people look at the efficient market hypothesis is that if Tesla is priced at $800, then that's what it should be, right? But a lot of people have been railing or arguing against this, what they call it EMH, is because that it doesn't incorporate the fact that we are not rational actors. This hypothesis plays on the fact that every person that participates in the stock market is rational, and that would be completely incorrect. And so Warren Buffett likes to say that the market is frequently efficient, but not always efficient. The difference in these ideas is like day and night. And again, it's not accounting for the behavioral risk that comes with market. But Ben, how do we manage behavioral risk, and what are the different types of risk, I guess, when it comes to our behavior?
Yeah, if you go to a finance textbook, there are two main types of risk you will find. The first is systematic risk. You can think of this risk as the entire market risk. So this could be a recession or a bull market, things like that. It's where the entire market is moving. That is the risk posed by systematic risk. Unsystematic risk is going to be the risk from a business. So it is separated from the systematic risk of the market risk. So it's what is the individual risk of a specific company that is not tied to the market risk of the entire market, right? So if the entire market moves down 10% and the company also moves down 10%, that is market risk, or I guess that's not the, you know what I'm trying to say.
Yeah.
The unsystematic risk would be if the market is moving up 5% and the company, its CEO does some scandalous stuff and that company drops 10 or 15%, right? So unsystematic risk is specific to businesses. Systematic risk is the market as a whole. Behavioral risk is the risk that you pose to your own investments. And so we often make decisions that are based in our emotions and due to biases that make our decisions not so good, or they're not based on sound investing principles. Sound investing principles, right? So these there are 5 things that are incorporated into behavioral risk, and these are posed by Daniel Crosby. He made these himself. You won't find these in a textbook. Behavioral risk is not something that is very academic in nature. He created these. Okay.
Why should we listen to Daniel Crosby?
He has a PhD in psychology.
That's it.
That's all you need to know. So when he's talking about behavioral risk, homie knows what he's talking about. But yeah, the first one is ego. So basically, you will try to save your pride and your ego when investing. And so if you make a bad investment decision, maybe you'll hold on to that bad investment because you don't want to hurt your ego and really admit that it was a bad investment decision, right? So you hold on to it and lose more money than you should have. That's an example of ego. Information. So if you have a lack of information or poor information about what you're investing in, that can result in a bad risk or a bad investment. The third is emotion. If you're investing, maybe when you're in high times of emotional stress, or if you're just someone who's prone to certain moods, if you're always happy or always sad, that can affect your investing decisions greatly. The fourth thing that goes into behavioral risk is attention. So whatever has been happening recently will be more prominent on your mind and will be weighted uh, unduly in your current decision making. So if something happened yesterday, I guess we are talking about this earlier. Like if you had gotten a car crash yesterday and then 2 days, like the next day, you have to make a decision about your insurance. You're more likely to buy higher priced insurance because you just got in a car crash yesterday. So it's on your mind that you just crashed the car and now you're paying more for insurance, right?
Could you relate this to stocks when it comes to attention?
Yeah. I guess a good example would be, let's say you are surfing the web or something, or you're on the news and you see something about how uh, tech stocks are looking at a major bubble here soon, and that they're going to go down for sure. But that's just one piece of information, and all the information about tech stocks and the market. So if you made a decision about investing later that day, you would overweight someone else's analysis about there being a bubble for tech stocks and possibly make an error in your decision for investing. Does that make sense?
Mm-hmm.
The last thing is conservation. So we have a tendency to want to keep the status quo, and we hate losing and we love gaining, but we especially hate losing. So we hate losing more than we like to gain. So we will minimize risk as much as possible. So invest in stocks that are the clear-cut winners, and if we are losing money, we will actually try to keep money in those stocks with the hope that they will go back up eventually and that we don't lose money. We make weird decisions like that that are not logical, right? But they are emotionally based. Sorry, I feel like I went off on a tangent, like a little too long on this, but
No, yeah, I think those tangents are important to understand,
mhm.
because just hearing the fact that, again, behavioral risk are ego, information, emotion, attention, and conservation. All of these, and it's interesting, Ben, when I asked him to bring up the point about attention, he mentioned also information risk in that, of
Mhm.
just paying attention to maybe a few sources instead of like everything that would be necessary. And a quote I really like about information risk that I do just want to add is, the information we possess is only as clean as the process by which it is considered. And so this leads me to what Daniel Crosby introduces as the 4 C's for rule-based in behavioral investing. So he lays out a framework to interpret information to make decision. This is more like not exactly a framework, because the 5 P's is more specific on how you actually pick the stocks, but this is the foundation
Yeah,
to
these are
how
like
you should manage.
principles.
Yeah, so this is the principles, the foundation of how you should actually manage these different risks, because these different risks don't just happen one at a time, but they can happen all together at once. 2 or 3 can take place. So with the 4 C's, to quickly go over them before I dive into each one. First C is consistency. Second is clarity. Third is courageousness. And fourth is conviction. So when we talk about consistency, right? Consistency has to do with the fact that as humans, we will often make decisions that aren't consistent at each and every single day. When you say you're going to eat healthy, you won't always choose to eat healthy each and every single day. So, but why is consistency really important? It's because that when you want to pick stocks, you should build a model, an algorithm, a decision-making process, a system, right? And so a lot of times people will build these systems, but will go against their own system, or they will feel like they need to add something to the system, right? And often throughout the book, he calls this models. So when we're talking about models, an example of models is present in the fact of what's happening in Wall Street, and that quantitative hedge funds are taking over Wall Street. And these hedge funds are taking away humans from making those decisions, and they're using models and computers. And as you know, computers are very emotionless, right? And so a thing with models that, again, like I mentioned, people try to do is add their own human judgment. But what you to us intuitively, we would think that adding our own human judgment on top of these models that we've already made would make it better, but it actually degrades the version of the model. So that, let's say that you have this system that you said, I will do X, Y, and Z to pick a stock, and then let's say like at that time you're like, oh well, here's X, Y, and Z. I just saw, this and this. I heard this news. Let me add something to it, right? That will actually do worse than if you just let the model itself run, so if you adding your human judgment. And so that is just something to be very aware of, that consistency has to do with the fact that you need to build a system, you need to figure out a model. And if you know how to code, it'll be even better if you can write it down and run it just through your computer and never have to really look at your thing. So number 2 has to do with clarity, and clarity is very straightforward. When it comes to you creating your system or your model, try to be very concise about what indicators, what data that you look at, because the more data you have, the more complexity you introduce, does not mean that you're going to actually be more accurate. If anything, it might stray you away from, and there's this idea of what they call overfitting, where you take a lot of data points and then you try to make it as closely as perfect as possible. But if we've learned anything about human beings, about the real world, there's so much complexity that you can't perfectly fit a theoretical model to what's actually going to happen out in the stock market. So the best thing you should do is find, I think he said 3 to 7 key indicators.
Yeah.
He said 3 to 7 key indicators. So this might be, maybe we're not going to go into the details of it, like debt to assets, profitability, different indicators and stuff. So again, clarity has to do with the fact that when you're creating your model, try to pick as little data and as few indicators as possible, because simplicity is key. Simplicity is perfection.
One thing to note on that is just that correlation doesn't mean causation. So when you have big data, you're going to have random information and data that will have a perfect fit with the past 10 years of data, but it won't mean anything for the future. So just a random side note, but keep going, Mel.
And so number 3 is courageousness. And some people might go, why would courageousness be a part of the stock market? It's not like something is gonna, happen to me. Well, when you're talking about money, a lot of emotions come into play, and sometimes you have to make decisions at times that seem very irrational to you, but is rational to the model that you made before, right? And so with courageousness, there's something, when you build your system, you want your system to save you from 2 major issues, and that is leading you to take a non-consensus view. And so this simply means that when people are all deciding to buy, and everyone's super eager and euphoric, you look at the market and say, okay, are people being irrationally euphoric? And you try to you don't view the market the same way that everybody is. That's simply what it means by not taking a non-consensus view. And number 2 is keep you invested almost all the time. So again, compound interest is a great thing. And as we mentioned before, it makes the difference between if you buy a stock, you try to time it, and then you sell it, come back in, time it, sell it, come back in, compared to if you would have held throughout the time of the rise, through the ups and downs. You would have more money at the end if you would keep your money invested than if you kept trying to time the market. And there's a lot of statistics and data to prove this. You can look this up yourself. But so when it comes to when it comes to formulating a superior investment strategy, 2 really simple things here is invest in companies that most people aren't investing in, right? So this means that you're finding the companies that aren't overhyped. And Ben will go into why that you want to look at these type of companies, because the price when things are overhyped does not make it a good purchase decision. And then second, you want to be correct about the companies that you pick. And obviously, if you're not correct, money goes down. But again, so important thing about courageousness is just the fact that you want to act opposite of the crowd, and it takes a lot of courage to do that a lot of times, because you will see everybody maybe making money when it keeps going up, but you can't really time when that come down will happen. All you can do is to follow your principles, your philosophy, your system, to decide when you should go out and be strong on that. But then on the flip side as well, is that you also need to know when to buy. So when everybody's selling, everyone's terrified, it takes courage for you to be like, okay, I know the market is at its bottom, and you might think it might keep going down, but if you follow your system and then you've thought about this beforehand, you've created a system for it, then you should have the courage to follow that system, take the trigger, and buy stocks. And so timing the market seems to be impossible, but there is evidence to suggest that that you can enter the market. There's evidence to suggest that when you enter the market, it makes no significant difference in returns. So that's just something to be mindful of. Were you going to add anything?
Are there any exceptions to that at all?
So the biggest exception is when there is bubbles. And so what is a bubble? A bubble is practically when the market is super euphoric. And I mean, you will hear, when there's a bubble, you will hear people calling the bubble for time and over again before the bubble actually does crash. And so a bubble, I'll go into the key indicators to, the signs to tell you that a bubble is occurring. So number one is exceedingly steep valuations, which means that companies are way overpriced. It means that like companies might be trading. So there's something called the PE ratio. It's the price to earnings. And so some companies might typically trade at around like 20%, 20 price to earnings ratio, but they might be at 100, right? So that's one indicator. Number two is excessive leverage. And so leverage simply means people are taking out loans to buy more stocks, right? And that's typically a really bad thing to do because you're investing money that is not yours in hopes that you can make a return that is greater than what you're taking that loan for. So that's why people use leverage, but typically highly advise against it. This is a tool that really professionals should only be using, but a lot of times when the market is euphoric, people are gonna take those steps to try to get more returns. Third is lax lending standards. So this means low interest rates. So right now we're at time where interest rates are at zero, which means
all-time lows.
All-time lows. That means that when you take out money from the bank, your interest lows are very favorable, and it makes it very easy for you to try to use that leverage again to try to beat the market, to beat the rates that you're taking the loan out for. Number four is low volatility. This means that the market just keeps going up, and you don't see any signs of it coming down. That should be a warning.
Hint.
Hint. And number five, last but not least, is high participation in risk assets. So this means people trading things that they normally wouldn't, people trading things that are typically considered risky. And if you've noticed, every single thing I've said is pointing that we are in a bubble right now. So be mindful. And a thing on risk assets that you can think of today is cryptocurrencies. I'm a big proponent of cryptocurrencies, but not every single crypto is a good investment, and they are risky. So that is just signs to show you of a bubble. But last but not least is number four, conviction. And so conviction really is just conviction is implying diversification. But when we're talking about diversification, there's something that is not very obvious. So whenever you aren't very diversified, you have a high chance of outperforming like an index or doing really well, getting really good returns, but you also have a high risk of losing everything. When you are super diversified, maybe having 100 stocks in your portfolio or 100 different assets and stuff, then you lower your chances of having outperforming the an index, right? So you might actually just be following what the S&P is returning, but you also lower your risk. Not being diversified results in high chance of doing really well, of good returns, of really good returns, and high chance of risk. And then when you are over diversified, you have lower chance of outperforming and lower chances of losing all your money. And so what you want to do is find the Goldilocks of this diversification. And this is important because you get the benefits of having the chance to outperform, but you also mitigate risk. And so this Goldilocks zone that Dr. Crosby recommends is about 25 stocks. And so this is really up to you. But where does conviction play into all of this? Whenever you decide to lower your diversification, you decrease from like maybe 50, 40, 25 stocks. You want to really understand the companies you are investing in, and you want to really have a strong belief that these companies will do well. And not just a belief that is from your mind, but a belief based on the systems you build and the data. And so having a strong conviction means that you don't have to be super duper diversified owning the entire market, but you need to be super, super confident in what you're investing in. And again, that Goldilocks zone is about 25 stocks. So with laying that foundation to understand again, the four C's for rule based and behavioral investing is consistency, clarity, courageousness, and conviction. With all that being said, though, how do we actually pick these stocks?
Yeah, so Dr. Crosby gives us the 5 P's of investing, and this is a framework that he created to give you a good sound investing principles. He doesn't say this is the best. He just says they are very good. He's been a financial advisor and in the area of behavioral investing for a very long time. He's a PhD in psychology, so a very smart dude, knows what he's talking about. Wait, do you have something to say? Or no? Okay. Um, but keep in mind that these principles or his rules are meant to give you the house edge. Okay, so you're not always going to win. Have patience with these. Investing takes time. Investing is not short term; it is a long term game. Okay, don't forget that. Another reminder is that you have to use a system. So as Mel pointed out, and we've already talked about already, your emotions are they will lead you to making improper decisions, right? So rely on models, okay? Don't rely on your human judgment because if you rely on models, you're more likely to get a better output. If you rely on your human judgment, you're more likely to be prone to those biases we talked about earlier from behavioral risk and make improper decisions.
I want to add quickly that this isn't just for us retail investors. He also says this for people that get their PhDs in financial
Yeah,
engineering. Like, just because you are educated, that does not correlate to the fact that you are always going to make the best decisions because, again, we are human.
yeah. And one thing it is literally impossible for you to make a decision without emotion. Like they've proven this. So humans make decisions with emotions. Okay. So models don't use emotions. Humans use emotions, and emotions don't actually help you make decisions in investing. They're just emotions. So, anyways, let's get to it. So the 5 P's of investing are price, property, pitfalls, people, and push. So we'll go over these in detail. The first one is price. This one is interesting because when you go to the supermarket, right, price is actually the biggest indicator of quality. So you see something that's high priced, you're like, wow, that must have had a lot of effort, a lot of quality, a lot of time that gone into making that product, right? That same logic doesn't necessarily hold for the stock market, though, right? Just because a company is, and this happens in bubbles, a company can easily be overpriced in bubbles and in the market. And the important part about price, though, with the stock market is that you'd never want to buy high, right? Because how do you make money in the stock market? You make money in the stock market from the difference between when you bought and when you sold. There's really no other way, right? So if you're buying a company at a high price, it's going to be harder for you to make money because you're betting that they're going to go even higher than their already high price, right? But if you buy it at a low price, there's a much higher chance that it will go even just reverse to the mean or just go to the average or even go higher, which will get you much higher returns. Because again, you make money on the difference between when you buy and when you sell, not on the price, right? So anything on that?
Besides that, I mean, it's like the simplest rule you hear. Like, if you ask someone how do you invest, they go, buy low, sell high.
Yeah.
But emotions will make you do the opposite at times because of FOMO.
Oh, one more thing is that you want to shoot because of this very simple idea. You want to shoot for value stocks, okay? And value stocks just means stocks that are undervalued by the market. You can look up more on this by your own, but it's a great indicator as to what stocks you should be buying. The second one is property, or another way to put it is just buy quality, okay? So remember that a stock is a share of a corporation or a company. Okay. So you're not buying some random number that just goes up and down. And it's actually a company that's behind that number. And what the company has, their product and who they are really matters. Okay. Their quality will eventually be reflected in future shares, right? So keep that in mind because you want to buy not only companies that have a good price, but are really good quality. Okay.
Mm-hmm.
And
I was going to say something that happens in the market is that sometimes the price will be disconnected from the quality. But if you understand the quality of the business and you see that it is undervalued, that is a great time to like buy more. And that's just the idea of value investing.
Exactly. And so how do you actually differentiate between companies? Like what makes a company a high quality company? Well, it's what we call a differentiator. And a differentiator is something that makes a company unique or gives it a competitive edge compared to its competition that is very difficult to overcome. Okay. When you think about large companies like Amazon, their infrastructure and their distribution network is already so large and so much, it's so insanely big that to mimic their distribution network would take insane amounts of resource and capital, and it's literally just almost it's implausible, if not impossible, to beat them at their own game, right? So that's something that differentiates Amazon from other companies. Other examples would be Google's search engine, Coca-Cola's their unique recipe. I didn't know it's still like a
A
secret,
secret?
which I
I
I
don't
don't know,
know.
bro.
They're selling death in a
They
can. So
Yeah, and then I guess one more is Harley Davidson as like brand identity. People, motorcyclists will get Harley Davidson like tattooed on them. Like I mean, that's pretty good brand quality.
it's
You
the
know,
same with
that's
Apple. Like
yeah. No,
people will
Apple
only
is
buy iPhones and stuff because even though an Android could have all better qualities and beat it, but it's an iPhone. Who's sending green text? I don't know. Not me.
exactly. um, and one more thing, if you want to get more in depth on how to identify quality companies, I'm not sure how to say his name, but it's called the Piotrowski F score. The name is Piotroski. These are 9 indicators that he made, and they're very good at predicting what companies are quality, and that will get you a good stock. So the third is pitfalls, or another way to put is consider risk. So Warren Buffett's 2 rules. His first rule is don't lose money, and his second rule is never forget the first rule. So if you didn't catch that, don't lose money, right? Uh, the When you're evaluating your market portfolio, if the most important thing is not to lose money, the thing you should be concentrating on the most really is your risk. Okay. And we've talked about this before, but you actually suffer the greatest risk in bull markets and you have the least risk in bear markets, simply meaning when markets are at an all time high, I think we're there right now. We're getting there. You are suffering the greatest risk because if it drops, you're going to lose 10% of whatever stocks you have. Whereas when the market's super low, which is a bear market, if the market goes up, you're going to make. It only has if it's at bedrock, it only has one place to go, right? So you're going to make money when it goes up.
To the
Um,
moon.
yes, sir. So one thing you just need to ask when you're making investment decisions is why might I be wrong? Because this will help you identify your risks that you are not seeing. Okay. Um, he also mentions 4 factors of being fooled or being duped or gullible about decisions, but they play very well into investing. And so keep these in mind. The first is social pressures. So people will be like, "Yeah, you got to invest in this crypto, like Dogecoin, bro. It's the next coin." Like, I don't. Is Dogecoin even still a thing?
I don't know.
Who knows? Anyways,
Why do people do it?
don't listen just because someone else is doing something doesn't mean you should do it, right? So beware of social pressures. Second is cognition. So what he says, lack of knowledge or clarity of thought. He's very clear it's not intelligence, but if you don't sit down and actually think about what you're investing in, then you have a good chance of not investing in the right thing,
A
right?
great example of this is that Warren Buffett hardly invests in any tech stocks. And Warren Buffett obviously has been around for a very long time and he was around the .com and he has seen tech stocks absolutely explode. But one thing he loves to say is invest in your realm of competency. So that goes again with cognition is that you shouldn't invest in a biomedical company that's everyone's talking about that might change the world if you yourself can't understand it or won't take the time to understand it.
That's a great point. Yeah, don't remember like going back to like the whole thing. Like you're investing in a company. If you don't understand the company, it's probably not a good investment for you, right? The third thing that he mentions is personality. Okay, so some people are more prone to being optimistic, some pessimistic, and some sadistic or whatever. Be aware of who you are and your optimism towards investments because that can play a huge role in how you make investing decisions. And you can get others, maybe a financial advisor, your parents, a trusted friend, to help mitigate those, right? And the fourth one is emotion. So don't let the prospect of a huge payday or someone telling you that this certain investment is going to make you triple your money within a year, because those are almost always scams, right?
Mhm.
So keep in mind that your emotion is important, and even like negative emotion too. Like don't be afraid to invest in semi-risky assets just because you don't want to lose money, right? It goes both ways.
And so there's a checklist that they consider. I'm trying to give Ben a break here because he's going to be talking a lot through this section. But so there's a five-part checklist, and I'll quickly name them out, and you can explain each part. So number 1, he says consider alternatives. 2 is seek dissent. 3 is keep track of previous decisions. 4 is avoid making decisions while at emotional extremes. And 5 is understand incentives. So going back to considering alternatives, what does that mean?
Consider alternatives. Remember that so decisions should never be made in a vacuum, right? Everything is only good or bad in relation to other decisions, right? So when you're making a decision about a company, consider the other companies around that are near or close to that company, because that'll help you understand that company. And he says his question that you should ask for this is, what's my next best option? Okay, so explore your alternatives.
That is a great way to put it. I didn't even think about that. That is something like where everything is relative. So you're only as good as someone next to you is as bad. Number 2, seek dissent.
Yeah, so this one's pretty simple. Just go ask someone that not just anyone, but find someone you trust or someone knowledgeable in the sphere that you're investing in, and ask them why you're wrong. And maybe they might not have anything, but a lot of times they'll see holes in your argument that you don't see. And if you are open-minded and allow them to, provide you new information, that can really be helpful for understanding where your risk is in your certain investments.
It seems that investing is really about, coming up with this thesis and reaffirming it. And that's like really interesting for anybody that might be scientific, but it's also really crucial point to understand that you are coming up with a reasoning why, building that with logic, and trying to avoid as much emotion. So then he mentions keep track of previous decisions. Why is this important?
How are you ever going to learn from your mistakes if you don't exactly remember why you chose something or even remember what the decision was, right? So if you can keep track of your decisions, what he says is he suggests writing down, whenever you're making an investment decision, write down why you're making that decision and what your thoughts are for the future. That way, when you can see that decision playing out, 5, 10 years in the future, you can go back to that paper that you wrote and you can see why you made those decisions. And then you can actually have a very solid and concrete reference to learn from your mistakes or affirm your decision and then gain more knowledge and solidify your knowledge in investing.
And last but not least, understanding incentives. I love the idea of incentives because I think that is how we are made as humans. Like we do things based on the incentives, but why should we understand incentives in terms of the stock market?
Yeah, this one is actually a little confusing to me. So
let's see. Financial. So what Ben has written down.
Yeah, sorry. I get lost in my notes sometimes.
Financial incentives are obvious drivers of investment decisions, but other considerations come into play as well. Investors should be aware of reputational and career risk as the real motivators that they are. So just reading off of this, I think this might have to do with the fact like some people might be making certain decisions based on the fact that they might make a lot of money if they, choose to not, invest in this certain company. So this might go with more like active managers and stuff, but I'm not sure on this point.
Yeah, I'm sorry that I can't remember this clearly, but if I remember correctly, like what he's saying, maybe like a good example would be, Mel, you're very bullish on Bitcoin, right?
Mm-hmm.
I think maybe let's say like Bitcoin in 5 years just started to like tank. And it was it was very obvious that like it was just going to go to zero, but you stayed with Bitcoin because you have been a Bitcoin proponent, right? It's like your incentive is to kind of, save face. Like you have a lot of riding on Bitcoin. And so even though you know that it's a bad decision, you keep that decision because your incentive is to do so for your reputational, financial, all your interests like that.
And it's like if I've been running around telling people invest in Bitcoin,
yeah,
and I'm gonna have that ego. That's another to tie it back to behavior risk. That is the ego risk right there. And the question that Dr. Crosby tells you to ask is what do I stand to gain or lose, and how is that coloring my perception? So understanding your own incentives, so why you want to even invest in that stock, is a big idea. And last but not least, there's some trickery that goes on in the world.
Yeah. You guys have probably heard of Enron, but if you haven't heard of Enron, they were basically a company that they did some very funny accounting stuff, and they ended up kind of fooling the entire market for a period of, I think it was like three-ish, 4-ish years, maybe even longer. I'm not totally sure. I was born after it happened, so who knows. But basically, they did some very funny stuff. They were doing very illegal things with their books and tricking investors, and they went bankrupt, and a lot of people lost a lot of money. So companies do manipulative things with their books that don't allow you to actually see what's going on. And so there are two kind of, I don't know what you call them.
I guess metrics,
Yeah,
scores,
like
ways
predictive models, I guess.
Yeah.
They're called the Montier C-score and the Altman Z-score. These are separate, but they're both pretty good at predicting whether a company is being manipulative with their books and whatnot. So you can look those up on your own if you're investing in a certain company, just as a double check, you know.
And I want to point out that was all information for number 3 in
Yeah.
the rules of the 5 P's of investing. And that's to tell you that risk is the most important part about investing, managing your risk. And once you start getting deeper and deeper into investing, you understand that losing 50% takes 100% to get to recoup all your money. So just because you lose 50, you can't think, oh, I just have to gain back 50. You have to gain back more. So you losing money hurts your portfolio a lot more than when you've gained that money. So again, that's why we spend so much time talking about risk. Risk management is important. But further than just the company itself, there's people that lead that company.
Mm-hmm. So the 4th P is people. He says follow the leader. And so the leaders of the company, they know a lot more about the company than anyone else, right? So if you see that a CEO or someone who's very high up in a company is selling their stock or buying back more of their stock, that is a pretty good indicator of what they think about the stock. Or even if a company as a whole is just buying back stocks, that's a good indicator of what they think about the company, right? And they know more about their company than anyone, right? So especially if a CEO is selling their stock, you might want to just look at why they're doing so. Of course, they may have personal reasons or other reasons. So it can and oftentimes is valid, but you want to do some more analysis on why they're doing so.
And the only thing I was going to add to this is that CEOs can't, and people in the company can't just sell their stocks whenever they want to. That would be insider trading. But so it's like paying attention to, they have times when they do, where they can get more stock and stuff. And so you have to just kind of pay attention. Like, are they choosing to keep those stocks? Or are they getting them and then immediately selling? And last but not least,
last is push or go with the flow. So there's something called momentum in investing. It's pretty much the same as you think of, inertia, like Newton's laws. So it's just momentum of a stock instead of momentum of like an object. But basically it says that it's this idea that when a stock is going up, even if it is not deserving of maintaining that growth, it will maintain that growth just because people have a tendency to think that things will stay the same, and people will keep purchasing the stock, perpetuating its growth, even though it hasn't done any more to deserve that growth. Does that make sense?
Yeah.
I think, okay. I want to make sure because I understand momentum as like a physics thing. But anyways, based on this, there's 2 things you want to do. Big idea from Benjamin Graham in his book. I forget which book it was, but
An Intelligent Investor.
I think it was The Intelligent Investor, but it could have been Securities Analysis.
I have both of those books. You don't expect to get a review. Maybe you can get a review of Security Analysis. That is a textbook, but we'll probably do The Intelligent Investor.
Mm-hmm. But he says that, if you're, because of momentum, you want to let your good picks, your best stocks run on. So let your profits run on when the stock is growing. And if a stock is falling or decreasing, you just want to cut short the losses and invest in something else because it will probably just keep going down. He also went a few pages, Dr. Crosby did, about using value stocks and momentum as 2 indicators to buy your stocks and how good it was historically and even currently to pick really great stocks that get you good investments. So these variables provide really great returns. Guys, that was a lot of information.
I want to add to, like, some of these ideas can seem conflicting because I know we talked about, like, hey, you don't want to buy when things are high, and you don't want to sell at certain times. And so this kind of shows that investing in itself is a complicated, and it takes time to understand these things. I highly again recommend buying the book or just reading the book. You can find it online. Please don't hurt me, Dr. Crosby. But it takes time to learn, study, and just because, a lot of us know people that just get into investing and then they think that they are just really, really smart. I remember I went back home, saw somebody I knew in high school, and they were like, "Hey man, I turned $200 to 2,000, man. Like, let me know. Are you a hedge fund manager now?" I don't believe so. So again, understand that there is a learning curve to investing, but as he said at the beginning, it's one of those things that isn't necessary, and it doesn't have to be as complicated. Everything that we're pointing out here is for people that want to be more active in their investing, right? And so you can go with the passive route because passive investing is not bad, right?
Well, even so, like, you would, if you were to passively invest, you'd want to take these principles and put them into some type of something, like a model maybe, that gives you the like similar output. It's just less active, so it's probably a little bit worse.
Yeah, and that's really all I wanted to add is just the fact that this is a lot of information.
Yeah.
This podcast is a good way to start, but you definitely have to do more research on your own time.
The world of investing is much larger than 45 minutes of me and Mel talking. So,
and we are not financial advisors. Any gains or losses you have is not due to us. With all that being said, quick recap of everything we talked about. Let's get it, Ben.
Okay, so the state of money management. Mel talked about passive and active investing. Passive just being, like an exchange traded fund or index fund or something like that. While active investing is actively managing your money. One thing is you got to make sure you manage your behavioral risk. So beware of your emotion and make sure you're using models and systems to make your decisions. The 4 C's of rule-based investing. 1 is consistency. 2 is clarity. 3 is courageousness. 4 is conviction. Do you want me to go over those? No? Okay, sweet. The 5 P's of investing, we have price, property, pitfalls, people, and push. I know it's a little ambiguous in terms of the name, so I'm going to say them fully. Price, never overpay. Property, buy quality. Pitfalls, consider risk. People, follow the leaders, so like CEOs and whatnot. Push, go with the flow, being momentum of stocks. That is what we covered today in a nutshell. I hope you guys got a lot of value out of this. This is not a lot of interpretation from us, mostly just kind of summarization, picking the most important topics and expanding on them with examples and whatnot.
And with all that being said,
a quote from Marmelicus Melius.
Gotta clear out the throat. Hope I don't stumble my words. I really like this one. This doesn't just apply to investing, but like this can apply to your entire life. If constraint sometimes affords a kind of liberation, while freedom affords a kind of enslavement, then people would be wise to seek out some measure of appropriate constraint. Barry, how do you say his last name?
Schwartz?
Barry Schwartz. I want to repeat this because I think it's a really good quote. If constraint sometimes affords a kind of liberation, while freedom affords a kind of enslavement, then people would be wise to seek out some measure of appropriate constraint. Barry Schwartz. And so in the realm of investing, this simply means that the constraint is having this model that you follow specifically. Like you do not go away from this model. If anything, if you want to change something, you change the model and you update your model based on logic and reasoning and data. Now, freedom is when you just say, I don't need a model. I'm gonna just be free and pick any stocks I want, right? And so when you have a model, you have a more peace of mind that you are making decisions based on this logical thought process you've had before. When you are free, you're really just kind of being enslaved to your emotions at the moment when you're picking stocks. But when it comes to life, which I think is is even more impactful, is that constraint is similar to discipline. When you are disciplined in, following your diet, discipline in, being a good person, going to sleep the right time, even though that you are constraining yourself to things like, hey, I'm not going to do X, Y, Z, I'm going to make sure I am following these rules, you actually gain a more sense of liberation. You feel more free. When you do those things, you feel accomplished and you live a better life. But when you allow yourself to, I guess, not be disciplined, you actually become enslaved to these bad habits, to all these external things that may cause you sadness and all that other. So I think this is an amazing quote that applies to both investing and life. So with all that being said, that was your quote from Marmelicus Melius.
I enjoyed that quote. Thank you. It was actually really good. Like you're right, it applies much broader to just life in general.
Yeah. As soon as I read it in the book, I was like, I stopped, took a picture of it, And thankfully, I was able to add it just in time. But with all that being said, I already told you guys, if you made it this far, thank you guys so much for listening. I hope you gained so much value from this. Again, like, share, subscribe, check out the blog, check out.
One thing, finals are here, and I've been doing a lot of other stuff, so I've been lacking on the blogs. If you have been reading them, thank you. If not, no worries in the future. But I'm going to kind of take a break for a little while to kind of get my life in order while we finish finals and move on to the next semester, just as a side note.
Yeah, we got a lot of life thinking to do, y'all. But I hope this podcast has been a guidance in your life. It definitely has been to mine. And with all that being said, peace.